Welcome back to Finanzfeuer Talk, the monthly briefing for January 2026. This is episode 3 of this series. Joining us are MB Capital Strategies and Augtopo.
Hello everyone, Octopo54.
Yes, so much has already happened at the beginning of this year in January. It's just crazy. You'd almost think it was already the end of 2026. So much has happened. Yes,
You're absolutely right about that. I can only confirm that. That's how I feel too. We
sat down together and picked out the most important points for you. First, let's talk about the start of the year. This year, instead of euphoria, we've seen volatility. So what happened? We've seen new all-time highs in the S&P, the Nasdaq, and even gold. For the first time, over 5,000 US dollars. A classic January effect, as it's known, where small caps are usually pulled up as well. But no, this time the small caps were significantly weaker than the larger value stocks. So what's going on here, so to speak? How should we interpret this in general? Well, so investors are remaining rather cautious and are afraid to invest in small caps. And capital is flowing selectively, meaning it's being allocated in a very targeted way, so to speak. What we're seeing is that an all-time high doesn't always mean market strength. And that's also the guideline here, why the market still feels very tough right now. At the moment, how do you see things right now, October? What's your take on it? How have you experienced it? After all, you have a bit more market experience than I do.
Yes, so I want to make one correction to your statement. My own portfolio also went up nicely. I should mention that too, not just the indices. Of course, the big ones always perform well. They've been doing that for years. Last year, I saw a lot of discussions where people said you should be more cautious with large caps now because they are highly valued. Yes, but they've been highly valued for quite some time, and yet they keep going up because the revenues match as well. And accordingly, I don't see any major reason to panic, at least not on my end, that now somehow to do things differently. But of course, small caps might now also offer a bit of a good opportunity. So maybe you could invest a little more there or adjust your portfolio a bit to include more of a small cap approach as a component. But ultimately, you definitely can't go wrong with large caps. At least that's how I see it for myself personally.
Yes, exactly. So you can generally see that what always performs, what has actually performed well over the past few years is companies like Nvidia, Microsoft, and of course Tesla. Those are kind of the front runners. Those are, of course, also the tech value caps in the end, if you want to call them that. And other stocks are simply lagging behind, which we could clearly see during this early year rally.
Yes, although that's just at the beginning of the year, as you called it. So the year still has another 11 months to go. So let's just give the other stocks a bit more time.
Exactly. What other important topics were there? And that's the topic of interest rates and also the Fed. So what happened there? Yes, the Fed meeting at the end of January brought no change in direction. That means interest rates will remain higher for longer, which isn't ideal for the market because the market had already priced in further rate cuts. Given the current situation, that's not going to happen for now. That means we currently have no further interest rate cuts in sight. So what does that ultimately mean? The era of easily accessible cheap money will remain nothing more than wishful thinking for the foreseeable future. And yes, one of the critical discussions that could be had right now is, for example, that the fundamental strength of cash flow consistently triumphs over speculative fantasy. That means interest rates will simply stay at these high levels for much longer than expected, so we won't have access to cheap money. As a direct result of this shift, other tangible assets like commodities might see a significant comeback since they are real assets and don't require massive amounts of cheap capital to thrive, unlike, for example, the capital-intensive sector of real estate. And that's also one of the reasons why real estate has been punished at the moment.
I'm actually quite surprised at this point. We all remember it was in 2020, right? That was the time of the coronavirus crisis. And that was basically the trigger because before that, everything was very, very cheap. We had extremely low interest rates, even negative rates. And during the coronavirus crisis, interest rates shot up dramatically. That was basically the initial rate that triggered this whole interest rate situation and completely turned it around with mortgage rates going from just a fraction of a percent up to 4% interest. And back then, people thought, okay, the coronavirus crisis would be over after a few years. It quickly became apparent that the vaccination rollout was progressing quite well. And then people expected that the interest rate, especially in the real estate sector, would go back down again. This would also mean that long-term interest rates on the capital market would decrease. And especially with mortgage rates, you can really see it quite clearly. You can always see how the trend is developing there. I always like to check that on Interhyp. At first, it actually dropped quite a bit. The 10-year mortgage rate was then around 3%, so in 2022, 2023. But now, if you look at it again 5 to 6 years after the corona crisis, you notice that not much has happened since then. Unfortunately, it has somehow remained stuck between 3 and 4%. So actually, over the course of 6 years, almost nothing has happened. And that was mainly, especially last year, when there was another jump in interest rates. Where was that in Europe? And then it was Germany with this special fund, these billions in debts that we took on, which led to this 10-year bond making another sharp jump upwards. It's definitely interesting to see how this will develop further, but you can already see that things are starting to stall a bit in the real estate sector. For investments in companies, when companies need capital, of course, they now have to accept the higher interest rates. That naturally makes things even more difficult for companies with financing. And regarding the debt in the USA, that's of course also an interesting question. We know that ever since Trump has been in office, his big goal has been to push interest rates down as much as possible so that debt refinancing can be carried out at a favorable interest rate. That's the reason why Trump is taking a lot of initiative to somehow to influence the Fed so that interest rates are reduced. Whether that will work out, whether he'll have any success there, remains to be seen. And if Trump is unable to successfully achieve his goals on the issue of lowering interest rates, then a very significant question arises regarding what effect that will ultimately have. If the United States finds itself in a position where it must soon repay its massive debts at much higher interest rates, that can undoubtedly lead to some very serious economic challenges for the country.
Exactly. I have two things to add. First, about the special fund you just mentioned. Yes, that's also quite simple. It's capital that is ultimately being released again, and that means we have more money in circulation again. And that in turn ultimately means that inflation is being fueled. I don't want to go into that too much right now. We'll come back to it at the end, but that's always the persistent scenario in the end. Yes, you want to do something, but of course, if inflation is being pushed up, that's not ideal either, ultimately. And as you have already correctly recognized, the USA simply needs low interest rates in order to be able to refinance itself. That means simply so they can have growth. And right now, the USA is in a mode of growth at any cost. We have to see how that will actually work out in the end. The fact is, we have to see what happens at the next Fed decision. Also with regard to who will be the next chairman of the Fed, if Powell really does, let's say, have to go in the end, to put it nicely, and is simply replaced. Currently, as far as I know, someone has now been announced who is, let's say, rather hawkish, who simply says he would prefer to keep interest rates higher for longer than necessary, which is of course difficult because, as I said, the US simply needs low interest rates just to be able to stay afloat in the end. And the longer interest rates stay high, the more negative it ultimately is for the US and also for growth. We can also see this from the fact that the US currently has a very weak dollar price, which of course is also not ideal for imports in the end. For exports, it's actually quite good because other currencies are higher. As a result, more is exported. Yes, the only question in the end is also, yes, to what extent is all of this actually good, the way it's happening? Otherwise, I think from my side, the topic would be finished for now. Or did you have anything else to add here regarding this? I just threw something in again briefly.
Maybe we could make a few predictions. So if you look at the forecasts, especially what the ECB or the Fed are saying as of today, it looks like there will be more stability in 2026, meaning few changes to the ECB interest rate. Now we're curious to see what will actually happen in 2026. But so far, As we've seen, even in 2025, things have been rather stable and there hasn't been much movement. If there is any movement in the ECB key interest rate or the US rate, it's more likely to be a slight downward trend, but only slight and not really any major steps downward.
Exactly. Then I actually already have the next topic ready. Namely, as I already mentioned, the indices are strong, but market breadth is weak. So that means the Dow, S&P, and Nasdaq are at record levels. But many individual stocks and also small caps, as already mentioned, are simply weak. What does that mean? Well, market performance is heavily concentrated in a few individual stocks. That means a few stocks are carrying the indices. And what does that ultimately mean? Well, it's simply an apparent stability that's being presented to us. But the broad majority of stocks are simply under pressure. That simply means, yes, it could still be the case that many investors ultimately just continue to lose because they end up betting on the wrong stocks. And the danger here is also that if everything is ultimately too concentrated in just a few stocks, and if this stock simply drops because, well, some important data or quarterly reports or, well, previously expected earnings aren't met, the entire index can just, well, get run over or ultimately come under pressure. Here as well, I'd just like to hand it over to you in case you have any additions or anything else that comes to mind regarding this topic.
Yeah, you can really sense this emotional game a bit. And this market psychology where investors always want to trade too much, to overreact. Personally, I just take it easy. I just wait it out. I've invested for the long term and I wait for the long term, and that's how I handle things. I never let myself go crazy over it. In the end, if you wait long enough, everything stabilizes anyway. And then you really don't need to worry about finding the right timing. Are you falling behind now? Do you maybe need to rebalance somehow and chase after returns? I think it's best to just invest in the stock market, stay in for the long term and wait it out. That's better than always letting yourself get too worked up over these market situations. Whether it's large caps or small caps, just having both in your portfolio is the safest option. That way you benefit from both.
Yes, that's true. Of course, depending on whether you're a more active or passive investor, you naturally look for the best way to invest your money. And I would say, ideally, you don't enter at the peak, but rather, if possible, after a low point. If you just take an ETF over 10 years, it all evens out anyway. But nonetheless, of course, it's nicer to get in at the bottom, provided that's possible. And here, the risk is simply that if the tech sector starts to crumble, corrections of 50% are possible because only a few individual companies are holding things up.
You just have to stick to your strategy. Stay true to it. I think that's the most important message we should take away from this. So fear of missing out is something you really need to watch out for so you don't fall for it and end up doing things you really shouldn't do. Also, the so-called night effect. That is always checking why your own portfolio isn't performing as well as your individual stocks, especially when you compare yourself to other portfolios. You always have to ask yourself, why isn't it working right now? Maybe it's actually just right, and the market situation could completely reverse next month because then other sectors might take the lead again. It always alternates bit by bit depending on the economic cycle over the months. So you shouldn't chase after other markets or sectors, but simply stay true to your own strategy. Make sure everything is set up correctly, and then sometimes just wait a little.
Yes, you said it exactly right. Just keep an eye on your strategy, stick to it, and ideally analyze or review your approach as well. Sometimes it's also good to write things down and stick to them, and then follow through with it exactly as planned. Yes, because as you said, chasing after things has never worked.
If in doubt, as always, the stock market wisdom says, diversify broadly, because then you're basically always a winner, because you always have a share of the winners in your portfolio.
Yes, and above all, buy when there's blood in the streets. So if you see in the news now, no idea, it's Armageddon, the stock market will never recover, it's at rock bottom and whatever else, then that's usually a pretty good time to just buy. And if the news is saying something like best possible returns of all time, everything is highly valued, and it's only going higher to the moon, as people like to say, then that's usually a time to be cautious and maybe take a closer look at things, so that in the end, you can simply exit with liquidity, with liquid assets if needed.
That's why, and if you can't handle timing psychologically, then it's best to just use savings plans. That's simply the easiest tool, which basically allows you to invest in the dip without even thinking about it. Ideally, you don't even notice it at all, and then you benefit when the markets go up again.
Yes, this only works if you invest money you can afford to lose. Otherwise, you're always somehow under pressure. That's the thing, I think.
I don't want to lose anything either. I only want to make profits.
Yeah, chance, risk, and so on. Okay, let's move on to the next topic. Energy is weak despite the current geopolitics. So what happened? Well, oil and gas are declining. There was a US intervention in Venezuela. Yes. What does that mean right now? Yes, fears about demand could dominate, so that in the end we might see further increases in oil prices. That didn't happen with the interventions in Venezuela. The market was relatively calm, I would say, as far as the oil business was concerned. So in the end, how would you assess this? So at the moment, the economy is more important than geopolitics, and yes, fundamentals versus sentiment, exactly. What does that mean? So we could either talk about the possibility that we have a delayed market reaction and that the whole thing will, well, I would say still rise, especially in the oil sector, especially now with Iran. We're currently seeing a very big conflict. Ultimately, it's a conflict that is, I would say, escalating more and more. Oil has reacted a bit here, but not as dramatically, I would say. So we're now at about 70 US dollars. Yes, so all of this hasn't really been fully priced in yet, which in my opinion is also causing, well, a bit of unrest for me, I would say, whether anything more will actually happen with oil at the moment. Personally, I now see oil more in relation to the economy, and given how OPEC is currently behaving, I actually expect it to fall back to between 30 and 50 US dollars. And then personally, I think that will probably be a good entry point for the long term as well. But at the moment, I just find it very extreme that it takes so long for anything to happen at all, or that sometimes there is no reaction whatsoever. I mean, that's really remarkable in my opinion.
Yes, the situation with Venezuela should actually be good or lower the oil price because Trump wants to promote oil drilling. After all, he wants to the oil reserves, what is available in Venezuela. He basically wants to use them and channel them into his industry. So that should actually increase the supply, which in turn should lower the price. But then all the wars in the Middle East, of course, are always a problem for the oil price and cause the oil price to rise because wars in the Middle East lead to that. It always leads to less oil being produced because ultimately there are disruptions in oil production and political risks. These could also result in individual countries not being able to provide or produce oil at all. So what do we have going on in the Middle East? There's the issue with Iran, which again is causing. There was the problem with all the demonstrations that are happening right now. You have to keep an eye on what's happening there again. Of course, there are conflicts again, and Europe and the USA also don't really like what's happening in Iran. That means one country is once again causing disputes with all sorts of other countries. And the situation with Israel still hasn't been resolved. That's yet another conflict in the Middle East. It's also unclear whether Iran and Israel might end up in conflict with each other again. I think there were also some threats in between. And with Syria, things are relatively calm at the moment. But whether that's a stable government now after Assad was overthrown is still a big question mark. All you can do is wait and see what happens there. Yes, and all these conflicts, they all factor into the oil price and can influence it. And there are quite a lot of political influences over which we have absolutely no real way to assess how things will develop. And what you also can't forget is that in the end, the oil price is also additionally controlled by OPEC. They can intervene at any time, ultimately in both directions. That too always remains a big question mark as to how it will go. So I would say it's rather a difficult field from my perspective.
Yes, that's true. So OPEC is definitely currently working on flooding the market with a bit more oil. That means they actually want to bring in some stability or even aim for a lower price. That's what we are seeing at the moment. That's how I would assess it right now. What I also want to mention regarding Venezuela, I once did some research on that too. And the situation there is simply that the break-even point is at 80 US dollars. That means, yes, actually the oil prices would have to be higher than 80 US dollars per barrel for Venezuela to even be able to produce profitably. Anything below $80 basically means the oil giants, so to speak, are losing money. Which oil giants am I talking about here? That would, of course, include Chevron, among others, who have already had talks directly with Donald Trump at the White House. Also, ConocoPhillips, ExxonMobil. So basically, the bigger players have met there. So, what I just wanted to quickly add, because in Venezuela, it's simply the case there's oil there that is generally very, very viscous. And that's extremely difficult to extract because, among other things, solvents have to be added. That makes the oil nice and thin, but this process is very labor intensive. And the entire infrastructure is also lacking in Venezuela. That means it all has to be completely rebuilt. And it's only profitable then. It's only profitable at $80 per barrel, or rather, what's profitable now is just breaking even on extraction. That means we would need higher oil prices here. I'll just leave it at that. Let's just take a moment to see how that might actually potentially unfold in the near future.
Unless you have a US president who somehow provides government subsidies, maybe that would somehow make it possible
In
a different way.
Of course, that can't be avoided, so that he naturally gets some advantages. Of course, yes, but those are the key points for Venezuela for now, I'd say. Yeah, that's already quite an intense conversation, seeing how this is developing. I really like how this is going so far, yes. Exactly, you already mentioned it. Of course, there are also currently the Middle East conflicts, which are also affecting supply chains. I'm primarily invested in shipping, after all. And that means we currently have an ongoing crisis in the Middle East. Attacks in the Red Sea and in Bab al-Mandab, those are the key facts. 90% of container traffic is currently avoiding that route. What does that mean? They're taking a complete detour. As a result, we have delivery times that are 10 to 14 days longer. This also means we have higher freight costs again, because freight rates are ultimately rising, of course. That means the markets are currently reacting in a rather numb way and are simply taking this route in the end. And as a result, costs are rising. Now, my question is, when will geopolitics be factored in again here? And yes, when will, well, cash flow is not necessarily the same as share price performance. That means many shipping stocks, as I can already see, have increased their dividends again, and in some cases are even paying special dividends once more. Or at least it's being discussed. But the share price performance has lagged behind the whole time. And now it's like this. I can see that starting this month, I would say yes. The shipping industry is now slowly but surely picking up nicely as well. And there are also a lot of mergers happening here as well. In the end, it's being discussed that one or another shipping company simply wants to swallow up some of its competitors. That means the supply will, let's say, be reduced even further. Those would be the key points I could contribute to this topic for now. October, I don't know if you have anything to add to that.
Yes, I do find it very interesting what's happening there, how complicated it actually is. With shipping, I wouldn't have thought so. I've been following this over the past few years as well. Or ever since I started investing in stocks, I've been looking at how the market is doing there and how things are with the supply chains. I also want to understand whether supply chains can be affected by this and which companies might be influenced by it. So somehow I have the feeling that every year there are conflicts in the shipping industry, especially with sea transport. And whether it's the Red Sea, like it is right now, or some other canal, like the Panama Canal, there were also conflicts there with Trump, who somehow wanted to buy or conquer it. That particular point actually surfaced and came up as a major topic of discussion during his first term as well. Yes, it's actually very interesting to consider. And again, it all fundamentally depends on the specific geographic positions of the countries that are located right next to these narrow sea routes. There are a lot of different factors involved, not only the ongoing political tensions and regional conflicts, but also the whole complex issue of piracy which also creates significant disruptions and major challenges for global supply chains at sea. And I think the issue with the Houthi rebels still hasn't been completely resolved either. There are also repeated flare-ups of new disputes with the USA in that area, and so on and so forth. And it's not as if shipping wasn't already complicated enough, considering the weather and rerouting due to storms and severe weather at sea. And then on top of that, all these geopolitical issues where you get the feeling that they'll never be resolved, especially in the Middle East with those narrow waterways that exist there.
Yes, that means we're definitely facing a risk right now, both at sea and on land as well as at sea. That means in general, we're paying a risk premium on pretty much everything right now, or at least that's how it feels. Whether it's sourcing goods or energy. Fortunately, we can still say right now that it's relatively inexpensive, but maybe that will increase even more in the future. But yes, in the end, that's just how it is for us as well. A risk premium that will probably be higher for shipping in the future, or at least will simply be priced in higher.
Yes, especially during the Corona period, there was a huge surge when all the supply chains were basically being overlooked. They were, in effect, severely restricted. And the further crises and additional problems are not going to steer things in a positive direction now. And of course, the risk premiums that are added on top of that will, of course, be felt in every industry. Every industry that ships its goods globally, distributes them internationally, will also be affected accordingly and will impose price surcharges.
Exactly, at least those that can simply pass them on to the end consumer.
Exactly.
All right, then on to the next topic, Greenland, which is a geopolitical game changer. There was a lot going on in Greenland. There was a lot of tension. Here, the USA, China, and Europe have all positioned themselves accordingly. Yes, there are some things to keep in mind here. It was a military significance that was ultimately assigned here. One could now debate what Trump actually wants with Greenland at all. Yes, in the long term, Greenland will probably become highly relevant. Ultimately, this is also due to the raw materials that are located there, and ultimately security as well, due to its positioning. Yes, why are markets perhaps ignoring something like this at the moment? I mean, we know Trump, he says a lot, he comes up with, yes, he comes around the corner with some big statements saying, for example, that Greenland only has a dog sled for defense.
It is
It is absolutely incredible what's happening there right now. Ultimately, Greenland is a massive, vital safety net for the planet, and it also has an abundance of untapped natural resources. That's probably also why Greenland is so important to Trump, or in general, because whoever controls raw materials in the long term ultimately holds a position of power. At least that's my view. Do you have anything to add on this, October?
Yeah, I think that was more, what would you even call it? More of a comedy event, more just to, just to have a good time and entertain the crowd.